Thank you for joining us today. My name again is Amber Tucker. I'm a director with Fino Della, Malone, and La Saracena, or FML. And I will allow, or I'll have Ed introduce himself before we get going as well.
I think allow is the right ad.
No, I didn't mean it that way.
Oh, okay. You're the gatekeeper here and everything. No, that's the way it should be. God, you wouldn't want me to be in that role. So it's nice to meet all of you virtually again. I'm in a bunker actually with a generator, 4 months of water with me, so Wi-Fi won't be an issue. So we're in it here. Thanks for this opportunity. My name is Ed Spinella. I'm the chair of the Tax Exempt Organizations Practice Group here at Murtha Cullina. I'm privileged to work with a variety of the participants, along with many of my colleagues. We do a lot of different things, essentially a full service firm, but our tax exempt group is a robust, I would say, keystone practice area, and we do a lot of work with organizations. So I'm looking forward to getting into the weeds a little bit on some of the donor restricted assets, charitable use restriction stuff later on. So thanks for your time.
Perfect. Some of the things we'll be going over today, this is my first time actually presenting on Zoom. I've used Zoom more times than I wish I had since March, but we've switched from WebEx to Zoom for this presentation, and what I like to do is polling questions. We have just a few, but I've created one that only matters a little bit just as a practice to see how it's going to work out. And so just getting it comfortable, did you listen to the first go around of this presentation? And that'll actually help me gauge and Ed gauge a little bit on not having to repeat too much, but we'll make sure that we cover enough, because it looks like, I'll give it just a few more seconds. Okay. So we are pretty close to, I'll share with you.
Oh, interesting.
So I believe you see on your screen now, 40% listened to the first go around, and 60% of you, this is your first time. So I will definitely go over some of the details that we went over last time. But what I'm trying to do is I add a little bit new slides, and I'll add some more information as well for those of you who have already listened to the first half of my information. Okay, so close that. Oh, and a little bit of housekeeping too. You all are muted at the moment, but if you'd like to chime in a question, please feel free to go ahead and do so. Or I'll also try to monitor the chat function if you want to put in a question there as well. Okay. So for the agenda, we're going to go over a little bit about the financial statement changes because it goes into play. I think some of the questions that I hear in and about non-for-profits, because some of the terminology has changed, there seems to be some confusion or hopefulness that some of the legal rules around the terminology has also changed. So we're going to go over that at a high level, go over what did change, and then Ed's going to bring in that legal concept to the solicitations and unintentional restrictions and ramifications of doing so. And then we'll also have time for questions at the end. But again, feel free to ask them throughout the presentation. Okay, so 2016-14. Oops. This is a FASB number for those of you that don't know that. So FASB has pushed down accounting changes to all of the nonprofits, and those changes were implemented for your financial statements last year, whether you're June year end, March, August, September, December, and anything in between. You would have already applied these changes. Those changes include other things other than net asset classifications. It included how to account for investments. It included adding a functional expense to your financial statements, those changes. But one of the impacts that's significant that's related to this presentation is that net asset classification. Okay. So one of our polling questions, and my goal of trying to be a little interactive, because I
There's some levity there. There's some good levity.
yeah. You know, in person, I like having conversations and getting people's feedback to help mold the presentation. So hopefully this polling will help guide the conversation a little bit. And we're almost there. We have about 80% of you have voted. Just give it 5 more seconds. Okay, and I'll share the results. So we have 15% of you that are very familiar, 41% are somewhat familiar, and 44% not familiar. So a pretty good spread. So we'll go over some of the details to get everyone to say very familiar. The good news about this is it's not a lot of information to get you very familiar. It's really just clarification of terminology when you talk about the net assets. Right, so everyone probably should be familiar with the historical formal presentation: unrestricted, temporarily restricted, permanently restricted. What the FASB changed was it brought it down into 2 groups, without donor restrictions and with donor restrictions, where without is just unrestricted and with donor restrictions is temporarily restricted and permanently restricted. What didn't change is the definitions and the meaning behind it. Okay, so with donor restrictions is still those that are for a purpose or for a time or for perpetuity, forever. Okay, so those concepts still are in play. It's just a change of overall terminology. And the reason why that was really made was for those that read the financial statements outside of that nonprofit industry. Okay, so when you have bankers or insurance, or even attorneys that not like Ed that are in that nonprofit world, but other attorneys that aren't in the nonprofit world, they didn't understand what temporarily restricted was naturally. So the hope was that with donor restrictions is a little bit more layman's term for anyone who's reading the financial statements to understand. Okay, for your financial statement presentation, a minimum requirement is this on your left: without donor restrictions and with donor restrictions.
I think you've got a question there, Amber. Will the slides be available after the presentation?
Yes, so we will send the slides out, and also we're recording this. So you'll get the video feed of it as well. Thank you, Ed. If you would just interject with any questions, that would be good. Okay, and then you can also provide the disaggregations. All right, so without donor restrictions, you have undesignated, operating reserves, and designated by the board. That's just an example. There could be others. I've seen investments. So they're breaking out investments out of the undesignated, so you can clearly see almost what's liquid.
Amber, I have a question for you, and it's relevant to what we've discussed before. Is, from a legal standpoint, there aren't a ton of changes per se, but it's sort of an opportunity for organizations to look under the tent and sort of revisit the underlying restrictions. What has your role been with those of your clients that have called you in and said, we know these new accounting standards are coming, can you help us make sure that we're making the right, judgment calls regarding what the restrictions are, how they're properly reflected, and what goes into a client's decision regarding whether to do the minimum requirement versus the alternative disaggregation approach, which is obviously a bit more detail oriented?
Really, however they're looking for their readers of the financial statements to gain the information. So while you're not required to show, for instance, the with donor restrictions, the time restricted, the purpose, and the endowment, you're not required to show that on the face of your financial statements. You are required to show it within the disclosures. Mm-hmm. You're not really hiding anything if you choose your minimum because it's within the notes. So it really depends on how clear you want to be in your financial statements and the presentation, and how much ease of information you want to give.
Yeah. And I would just say a lot of the clients that I work with, they've said that many donors these days, and it's not necessarily just significant donors, they view themselves as investors. So this is a way for them to have additional information. And I guess it goes into, if you were to create a deck for a potential investor, what's the best way to present that information to that potential investor, right? That's sort of one way we were talking about that this plays a role.
Yes.
Yeah.
Yes. You know, with this financial statement update, there was new liquidity notes
Yep.
required as well, right?
Yep.
Liquidity notes give somewhat of the same information as the breakdown, the disaggregation of this information. So
Right.
it's just how much ease do you want to give the reader of the financial statements to get to the information? Pretty much it's all there. It's just a matter of whether it's on the face or within the footnotes.
Right.
Okay. No other questions? Okay. One thing I wanted to bring up, because it is important with the giving or the receiving of contributions, the only person or when receiving contributions, only the third party that gives the contribution can place the restriction. The board or management, they can reserve the donations for specific purposes, and that's going to be board designated. But only the donor can put the restrictions on. So it will be undesignated unless the third party brings in the restriction. Now, what's interesting, and we'll show it later in this presentation, is sometimes there is unperceived restrictions that you weren't anticipating that the donor intends. So it very much depends on how you ask for your funding, whether it's restricted or not restricted, and what they are perceiving your ask to be. Okay, but
that's a huge point, Amber. Is that I'm gonna hit it over the head multiple times, but just be very careful with implicit or explicit restrictions. You know, and many times you may not even intend to impress a donation with a restriction, but you know, I live and die by the approach ready, aim, fire, and that's the approach with solicitations. You got to be very careful. So I'm sorry,
yes.
go ahead. Yeah.
No, please interject as much as you want. So while board designated was always a thing, this financial statement presentation change requires now more information to be disclosed on your financial statements. So if you choose the minimum disclosure on your face of your financials, just showing net assets without donor restrictions, you are still required to disclose how much of the funds within that balance is board designated and what is the nature of the restriction and the dollar amount. You can either be in verbiage or in a chart, but it must be disclosed at some point during the financial statement. Okay. One more financial statement change occurred this year, right? So if you're a 6/30/18, I'm sorry, a 6/30 year end, and you just finished your 2020 year, or if you're December 30, your 2019 statement was applicable for this revenue change. There was guidance that came out to clarify contributions that came in mostly for conditional gifts, right? So historically, conditional gifts came in, and if I, Amber, am giving a nonprofit $100,000, if you also fundraise another $100,000, so almost like a matching concept, that's conditional. You can't record my $100,000 gift to you until you raise that $100,000, okay? There's now a little bit enhancement to a conditional gift. It needs to be a barrier and right to a return. So my example still exists. That's still a conditional gift. But if I'm a foundation and I'm giving you $100,000 to build a building, or you need to give me the $100,000 back, they're saying, FASB's new rules are saying that's no longer conditional to build a building. That is a restricted gift, but it's not conditional because there's no specific stipulations on how to build a building, where to build the building, what its purpose is for. So it's just a restricted gift. Now, if I give you $100,000 to build a building by December 31st to run program End Hunger for Connecticut, that would be considered a conditional gift because there's specific barriers that you have to achieve to gain that revenue. Okay, so what ASU 2018-08, I don't know why we can't go by words anymore. Now we're even more driven than we were in the past. You have to be able to say who the primary beneficiary is. You have to talk about whether it's exchange or contribution, and then talk about the barriers and rights. And what I really want to focus on, because we've done separate revenue recognition trainings, and I can get you more of that information if you'd like, the barrier and the conditional gifts really fits into our conversations here. Making sure that there's a right to return. So if you don't use the money how they intend, you have to return the money, right? And there's a barrier. And those barriers need to be a measurable performance with maybe some kind of stipulations, such as I'm going to give you $100,000 if you serve 100 veterans, something like that, some kind of stipulation, limits, amounts that you're trying to achieve, goals that you're trying to achieve, and those sort of things. Those are barriers. And the big change is the and, because it used to just be do this or return the money. That was conditional. And now that's not enough to be conditional. Okay.
I was just going to say, Amber, the one big difference here is when you're talking about a for-profit business or an individual that is making a quote unquote conditional gift, that can't revert back to that individual or that for-profit, and I know it's axiomatic to probably all of us on the call, but I have had clients before who said, I've got a donor who's indicated a preference that we use the gift for something. We're not going to be able to do this. Now the donor is really upset. What am I supposed to do? The donor wants the money back. Mm-hmm. Well, the donor literally can't get the money back. That's not happening. Once that gift is made, it's impressed with a general, it's going to be used for 501c3 purpose at that point. Some donors put in triggers, so contingent beneficiaries or things like that, but it's not coming back. I mean, I know that's axiomatic, but if it's a for-profit business or an individual making that gift, that's it. And they can't take that tax deduction if it's somehow contingent. Pledge agreements, that's a different animal and it beyond the scope of this discussion. But that does happen sometimes. A donor will be so upset, or even a donor's successors years later will say, this isn't what our father or our mom or our grandfather wanted to do. But the bottom line is they don't have standing, nor do they have the ability to come after that gift after it's been made. Even if it's an endowment, even if there's a gift instrument language saying that they can express preferences and things like that, but they can't get the gift back. That's very, 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 very clear in the law. Sorry about that. I went on a little bit of a.
It's okay. Say that last sentence again. They can't give.
They can't get the gift back once they've made a donation, irrespective of whether or not it's to an endowment. If they want to take that charitable tax deduction, it's not coming back. And I just saw, does that include event giving? Yes. If a donor has made the contribution and it's gone into the bank account of the 501c3, the 501c3 really can't turn around and then give that money back. It could agree to deviate the use. It could agree to direct a donation elsewhere, to avoid some type of like back and forth. But once a gift is made, in order for it to be effective, the donor has lost the ability to take that back. That's different for a 501c3 grant maker. So a private foundation, for example, they could claw it back. They could have all kinds of contingencies. They could use, performance thresholds or things like that to say, we're not going to give you the next installment unless you do the following things. So conditional gifts are, from a legal standpoint, are not a one size fits all. It depends who the donor is, I guess, is a way to look at it.
Okay, that's interesting.
Yeah, because it does happen. You have instances where a donor or the donor's family becomes upset with how the gift is used, and they'll say, we want the endowment back. Or, you know what, fine. And someone just said, in today's world, does that apply when the event is canceled? Excellent question. I think it depends. If someone has cut a check and made the donation, it becomes very hard to return that money, because at that point, it belongs to the 501c3. Now, you could work things out with them and say, you know, at the next event, we'll give you a credit or something like that. But I don't know how a donor takes that charitable tax deduction at that point. I don't know how a 501c3 returns the money. It becomes very hard. If you worked language into the ask, saying that this is contingent on the event occurring or something like that, maybe then you could have a conversation about it. But you need to be careful about
That's
it.
very interesting. I could see that for a contribution. I struggle
Yeah,
a little bit on the event side, because if I'm giving
yeah.
sponsorship for your golf tournament and then the golf tournament cancels, are you,
Yep.
is what you're saying is, as the sponsor, I can't ask for my money back when the golf event doesn't occur?
You could certainly ask for it, but it's not as simple as the charity saying, okay, we'll cut you the check, because for the 501c3, once you've taken that money in and it's now an asset, right? It becomes hard to return that money, right? And it's borderline impossible. I think the most you could do is work out a fair credit. This is from a legal perspective, you know, because for me, once a gift is made, that it's been transferred. A private individual or a for-profit business has conveyed the gift. Now, if it's a commitment, if someone said, yep, we were going to cut you that $5,000 check, well, that's a lot easier at that point, because they can't take the deduction at that point in time.
Right.
This is all complicated by the fact that you're not dealing with anonymous people that you're never going to work with again, right? So you
Right.
want to be able to work with them. It's not as easy as saying, nope, good luck, see you next year. I mean, you want to work with your donors, right? So if you
Absolutely.
have to cancel an event, it's not as easy as saying, no, we're not going to do it. You know, we're not going to give you the money back and good luck next year. You have to work with them, you know, and I think it's an opportunity to continue to communicate and to figure something out that's creative with them. But from a 501c3 standpoint, it's very hard for a 501c to take a contribution, put it in their bank, and then just sort of turn around and send it back to the donor. That's not, I'm not saying it's impossible, but it's not an easy ask for a 501c3. And it could have significant ramifications. Sorry, I'm going off on a tangent, Amber. I apologize.
No, I agree it's a tangent, but I think it's a worthy one, because it is something that a lot of organizations are dealing with. I know my clients had quite a few events that were canceled. And
I see someone had a good one, like a sponsorship agreement, right? Well, that's a little bit different, right? Because it's not as much as we're going to cut you this money. It's like the sponsorship agreement, and then there's no event, so there's no sponsorship, right? I still think it's not as easy as saying, well, we didn't have the event and we didn't put your ad in there, so here's the money back. I don't think it's necessarily that easy. But I think that if you have an agreement saying our commitment, our cutting the check is predicated on there being an event, then yes, we've got more that we can work with at that point. But I just want to make it clear to everyone, it's not black and white, in the sense that you're dealing with donors and people that support you, right? So it's not as simple as telling them, nope, we're a 501c3, we cut the check, it's in our bank account, we can't return it to you. So I guess that's the thing I want to make clear to people. So.
yes. Okay.
Sorry, Amber, I've made a complete mess of this slide. I apologize.
No, it's fine. It's fine. I do want to address, there was one other question related to this, and grants. And so how do grants fit into conditional gifts and giving? So there's really two types of grants that you're getting. You're either getting grants that, let's say you're getting a state funded grant and it's coming down to the organization. If it's just to run the organization, right, that is considered a contribution, right? And if you have to follow things like state single audit rules, the cost allocation plans, the allowable costs, that's the word I was thinking of, allowable costs, that's conditional, okay? However, if you're getting a grant, say you're from, if you're getting a grant from Department of Developmental Services, DDS, and those funds coming down are for specific individuals, those are not considered contributions. That's going to be an exchange. You're paying service, you're receiving funding to service a specific person. And that could be applied to any of those grants. If it's for your overarching mission and you decide who receives the services, that's considered a contribution. Okay. And then you would follow those conditional rules. All right.
Amber, there's actually a couple more questions there.
Oh,
You-
okay.
I opened up the floodgates.
Yeah, you did, Ed.
That's what I'm good for. I think one of them was from Eliza rather. Now I can't see it though.
How about a religious membership organization that collects dues fees that are deductible and someone leaves and wants a refund of a portion of the
That's really interesting. Really interesting. And this particular question comes from an attorney, so that's why it's so difficult. I will say this, it's complicated. If that individual has already taken a tax deduction on some portion of their dues and fees, which not always is the case, depending on what you get in return for those dues and fees, I think it's definitely too late at that point. It can get a little bit complicated though, depending on what the person's argument is as far as, well, my understanding was I would get an entire year of certain services or certain benefits. And I think I think the bottom line is it's very much a facts and circumstances type of issue. But I think, the easy answer is if you've paid dues and fees and you claimed a deduction on some portion thereof because you didn't get a return benefit, you're not getting that back. I mean, you've basically claimed that part was a donation. And once you've donated something, taken the deduction, I mean, you've essentially undermined any argument that you have some type of reversionary right to it. Where things get tricky, though, is this issue of, well, some of the dues and fees are for return services or certain benefits that I explicitly understood I would receive in consideration for that. That's where things can get a little interesting. And again, I want to impress upon everyone, there's the legal component to all of this, and then there's also the issue of how this plays out with relationships and optics and politics and all that stuff. So I would really, we don't, as lawyers, a lot of times we speak to the law, but then we also speak to, the practicalities of a situation and making sure you're making a fully informed decision. But excellent question.
Okay. All right, so that leads us into our next polling question, which will help.
Amber, if this is a really interesting issue, what we can do together after this call is we can send some resources to people and put some additional information, because it really is it's a great question, especially right now with things being so fluid, events being canceled, and I mean, it's all about change and adaptations and curveballs right now. So might be a good thing for us to do a follow-up on to this group.
No, I completely agree, because, even from the financial world, we are questioning that if I had a golf event that was supposed to be in June,
right,
pushed to September, do I recognize revenue or do I not recognize revenue?
Right.
Financial world, I was like, well, you still owe them a golf tournament. So
right,
let's push it. But if you legally can't give the money back, I think that's a different story. So we should definitely have some follow-up.
It's interesting.
All right. The next polling question. My organization has mailed an appeal letter or a request for funding this year. Yes or no? Okay, and you guys are quick to respond. Thank you. I'll just give it a few more seconds. All right. And it looks like we have a good audience, because most of you, 65% of you, have already sent out some sort of appeal letter or request for funding. So that it'll very much apply to the next set of slides. And for those of you who haven't sent it out yet, it's good information in advance to make sure you're asking for funding the right way. So Ed, take it from here.
Oh boy. All right. So I think I'll revisit the phrase that I said before is the ready, aim, fire approach. When you're thinking of making solicitations, you got to be very careful. What makes it even more difficult now is just how much uncertainty there is. And it's not just whether or not an event is going to take place. It's where's our money coming from? Did we think we could count on COVID relief funding for XYZ, but now DDS, and this might strike some of you as a little close to home, but is now DDS telling us that we can't use that funding for certain things, or that we have to pay back some of our funding because we took PPP funds. There's a lot moving at once, and I think that in my mind makes it really important to build flexibility into your solicitations. Okay, so if you take nothing out of this, take away the ready, aim, fire, and then really try to build in flexibility. Okay, and I've always sort of said that to clients, because you just don't know what tomorrow is going to bring, right? What are the things that we care about? In other words, when I talk about creating unintentional limitations, unintentional restrictions, these are situations where you didn't mean to restrict the options for which you could use a donation, but it happened anyways. And that's because the law is set up in a manner where if you make a solicitation and say certain things, the law basically, whether you like it or not, it impresses restrictions on the money as it comes in. And I've had I've had some clients before say, this wasn't our intention. And I've told them, I know it wasn't your intention, but it's one of those areas of the law where you don't necessarily have to intend to do something. The law looks at the circumstances at play and makes a decision based on what you put out there and how donors responded. So what do we care about when we talk about charitable solicitations and unintentional restrictions? What are the things that we care about? Well, one is that donors make informed decisions, okay? Because I can tell you this is like my number one goal when I'm talking to clients about decisions and difficult ones at that. I would say, like, I can't make the decision for you, but my job is to help you make an informed one. Same thing with a donor. You want the donor to feel enfranchised, and you want them to, when they're cutting that check, to think, yes, I understand what this is going to go towards. I understand what it's going to be used for. I understand perhaps what it's not going to be used for. Protecting the public from fraud and deceptive practices. This is what the Department of Consumer Protection and the Attorney General's office really care about. They don't want, and it's none of the people on this call, let me be very frank, but there are third-party actors out there that raise money saying, oh, we're going to use it for the following things. And then you look at the small little disclaimer in the charitable solicitation and it says, no, we're not, we're going to use it for these things. Or you go to a clothing collection bin is always the easy target. And there's actually a law in the books that says if you're a for-profit soliciting clothing, you have to say that, because people kept on filing complaints with the Department of Consumer Protection saying, I thought I was giving clothing to a for-profit, or I thought I was giving clothing to a for-profit that was going to use things for XYZ. Preserving, responsibly navigating donor-imposed restrictions. And I'm going to hammer this concept down in a couple slides, but the law hates perpetuity, right? Because perpetuity is a long time and it can take on all kinds of different faces depending on what tomorrow brings. And it's not always easy to navigate that. But this is one area of the law that if a donor says, I want you to use this gift and preserve some portion of this gift as an endowment, the law says you've got to do that. And if it becomes really hard, then we'll talk about some of the things you can do to navigate that restriction. But you can't just, pretend that it doesn't exist or just unilaterally release it. It's not that easy. Responding to the challenges posed by the technological evolution of fundraising via social media. So social media, if properly utilized, is an awesome way to raise money. It really is. There were some awesome articles in, I think it was the Hartford Business Journal, about some of these virtual fundraisers and these remote fundraisers and things like that. And they were really creative entrepreneurial ideas that played out in real time. The problem with social media is it's really easy for someone, even with good intentions, to go out there, start raising money and make a real mess of things, okay? And I'm going to talk about what's now a dated example, but the ALCS Ice Bucket Challenge is an example of something that could have gone really wrong, but ended up going in a really positive direction. So we're gonna look at that as an example. And then it's all about with organizations, like I always tell them, your one of your most valuable assets is your goodwill. It's an intangible, right? So it doesn't show up on the balance sheet for Amber, but it's so important, okay? Your goodwill and your reputation with the public, with your known donors, and yeah, with the regulators too. So that goes hand in hand with all this discussion. All right, so next slide, Amber, if you wouldn't mind. All right, and okay, I don't have a poll for this, but does anyone know what that picture is? I would be really, really, really interested to see if anyone knows what that is. You can just throw it in the chat. Rob's looking at it. Rob thinks he knows what it is. No? Okay. All right, it is a horse trough. And the reason why I put it in there is because it was used as an example to me many years ago by the gentleman who mentored me, which is, Tango's own Jack Horak. And I always used to think, why is he using this horse trough analogy? And then I, and ended into this bizarre conversation one day. We were talking about it, but the idea is that who needs a horse trough today, right? There are some people out there that have horses, but they're probably not out there a lot, and maybe you put one into place here. But the idea is that let's just pretend a donor at one point said, I'm going to give you XYZ $1,000 to establish and maintain a horse trough. At some point, that horse trough is just going to be a burden, right? And you're going to look at it and say, what the heck are we doing with this thing? I see Sue Sadecki just said, I use that example all the time. Good. Oh, and there's a question too that I missed. This is a good one. It says, what if seed funding was provided with no direction for the use of the funding, and the board created an endowment and now wants to use a portion of it for program services? Do we go back to the donor, which was the state of Connecticut? Oh, that's always fun. It's just wonderful to go back to the state and ask for permission. Well, it says in your question, and again, this is very fact specific, but it says if it was provided with no direction and the board created an endowment. Okay, the board can't create an endowment. That goes back to Amber's point regarding board designated restricted funds. Because what one board restricts, another board can unrestrict, right? All of these restrictions that we're talking about are coming from outside of the organization. So again, I suspect there's a little bit more nuance to that question, and we can discuss it offline if you care to. But again, the board can't create a legally enforceable restriction, right? Not within the organization. There's some nuances to that, but that's something to always keep in mind. All right, so the legal enforceability of donor restrictions, I think if you take nothing out of this, it's been a long time. It predates this country. It came over from, I believe, England. UPMIFA, which I'm sure some of you are familiar with, and this accounting standard that Amber is talking about, they stirred the pot. Okay, they created some concepts and highlighted some areas where it brought up some controversy, frankly, amongst the regulators and other folks who advise nonprofits. But it didn't really change the legal landscape, not when it comes to the enforceability of donor restrictions. I don't think so, at least. I don't think the Attorney General's office thinks so. So can you go to the next slide, please? Love that horse trough. So these are examples, and I won't walk through them. I did use Tango Foundation, Rob. So there you go. It's I guess so. It's an implicit message to people from for-profits that might be on this call. They should think about cutting a check. But this shows you in a very simplified form the types of restrictions the law permits donors to make. Right. So one's unrestricted. I give 10K to the Tango Foundation. One's restricted to use. I give 10K to the foundation for its Rising Star Scholarship Program, which is an awesome program. And you should all apply for that if you have Rising Stars, right, Rob? Then you have true endowment restrictions. I give 10K to Tango, the principal to be kept intact, and income thereof, so I made a mistake, to be used to support the scholarship program. That's like a double whammy technically, because I've impressed an endowment and a use restriction there. You can have an endowment that generates unrestricted income, right, Amber? But
Yes.
But this is technically a double whammy. It's a true endowment with a use restriction. All right, so next slide, please. What creates a binding restriction? And I won't run through all of this. And I've actually included some legal definitions below, which is from UPMIFA, which is the state statute that gets into institutional funds and endowments and stuff like that. But I would tell you this, it's broader than you think it is, okay? Verbal exchange, I don't know. You know, if it's two people talking on the phone, there have been instances where people say, well, if it's two people talking on the phone, then there's a follow-up email or there's notes taken from the call. But I would not feel, I would not, as a lawyer, I would not rely solely upon a verbal exchange, okay? Email exchanges going back, or an email after a call memorializing what was discussed. Now we're talking, right? But a verbal exchange is, in my opinion, I'm sort of a conservative person. I think it's a little bit shaky ground. What about restrictions imposed after a gift has been completed? And I had this happen to a client years ago where someone cut a check. After the check went into their bank account, and I think it was like a month later, the donor said, you know, I'd also like you to do the following things. The organization worked with that donor because, again, relationships matter. But I was very clear to them. I said, you don't have to do that. This was an unrestricted gift. It came in, title transferred. The donor technically doesn't have the ability now to add restrictions to it, you know, months later, whatever it was. And then this last one's a biggie, right? A response to a solicitation, right? And I've seen so many of these with COVID, right? Is that there's a lot of organizations that are really suffering. They're thinking of ways to navigate this and position themselves to come out the other side. Awesome appeals. There's been some wonderful appeals, but some of them, they get into the weeds and they say, you're going to use your contribution to support the following programs. And there's like a couple bullet points. And I don't see any kind of what I would call sort of catch-all language or sort of flexible language. Say, the types of things we hope to do with your generous donation are the following. Well, that's good. The types of things, in other words, they include the following things. You know, I will tell you this: a blanket ask is not always effective, right? Because a donor wants to know, what is this going towards? Why am I cutting this check? Why? You can split that baby a little bit. You can say, here are the things we hope to use this for, or, you know, we intend to use this gift for the following things, or including you can work with that, right? Because you don't want the donor to feel that they've been lied to, right? Or that you've made a misrepresentation to get their money. So that's important. But again, work on that nuanced situation. Don't back into a corner. Don't limit yourself to what you can use that for, because we don't know what tomorrow's going to bring, especially in this environment. So just be careful about that. Same thing. If you have an endowment and you tell a donor your gift is going into the endowment, now it's subject to that endowment restriction. So it's one of those things to think of, you know. All right, so you want to go ahead, Amber? All right, so here are my tips. Be very careful about how you phrase your ask. We talked about that. Know who's soliciting restricted gifts on your behalf. Now, this is a fun one. This is the Ice Bucket Challenge, right? Very, very little known fact. The people who went out there and raised millions of dollars for that organization were not authorized to do that, okay? These weren't authorized volunteers. They weren't employees. They were just some people who wanted to help. That could have gone in a lot of bad directions, depending on, you know, they weren't trying to misappropriate assets. That's good. They were good people. But what if they went out there and said, we're raising all this money and it's going to be used for the following programs? And I mean, they could have, without even getting the permission of the organization, put all kinds of restrictions on the money as it came in. And then you've got a mess where now the organization's saying, what are we going to do here? We've got these people who were well-intentioned. They went out there, they raised millions of dollars, and we got to clean this up because we can't use this money. We can't use it for what they raised it for. And it's insane to me, but that is true. Lightning struck on that one, and thank goodness no one got burned by it. But here's another one, and I've had clients, none of whom are on this call, and that is true, but I've had clients call me and say, we've got our accounting firm here. We're looking at these new restrictions. No one can find any documentation anywhere that corroborates this restriction that we've just always carried forward. And they've gone back and said, well, I've talked to 5 accounting firms removed from this. No one knows why this restriction was booked on our balance sheet, 50, 60 years ago. Well, I'll tell you this. Don't go to the Attorney General office and say, we lost the documentation. Can we just release it? Can we just put it into our unrestricted? Don't do that. Please don't do that. What you can do is go to them and say, we'd like to consider using it for the following things. Are you okay with this? But if it's a use restriction and it doesn't look like it's temporary, in other words, it wasn't tied to building a building that you've already built and you don't need the money for anymore, something like that. Don't go in there saying, we don't know where the documentation is. And we're just going to unrestrict it because we need the money. It's not good. It's not going to be well received. I can assure you of that. Don't forget about unrelated business income tax. In other words, depending on how you want to work with your donors, depending on how you set up that ad or that sponsorship, it may generate taxable income to you or it may not. Okay, you want it to be a sponsorship. I don't want to use the term ad because that's not good. But think of UBIT too. That's not the purpose of this call, but UBIT's still relevant for this. Consider a gift acceptance policy, and many of you may already have it. The reason I like gift acceptance policies is they give you something to fall back on. If you have a donor who shows up one day and says, I want to give you this fishing village in Nova Scotia, and I think it's a wonderful property, and I think you should have it, okay? Well, that sounds wonderful, and you've always been a good supporter, but we have a gift acceptance policy, and when it comes to real estate, we don't accept real estate without the following things. And, it gives you something to push back on in a way that's professional and not going to feel personal to this individual, okay? And if you think that that's a fake hypothetical, it's not. That was real. And that was interesting. I never got to see the cabin. I would like to fish up there. But in any event.
I'd add to that, too.
What's that?
If I can just chime in.
Go ahead.
I'd add to that. Make sure the policy is staying up to date, right? So more and more people are now using social media for your gift.
Bitcoin, if you had
GoFundMes and all that, make sure you're keeping up to date with all the new ways that you're fundraising.
And like the Bitcoin stuff and all this, that's around. And I've had clients call me and say, what am I supposed to do with this? They want, I said, well, you what you do with it is you don't accept it and you plead with them to liquidate the Bitcoin and then send you the cash. But there are ways to accept title of the Bitcoin, but be very careful. And then consider a written donor agreement. I mean, if it's a big donation and you feel like this individual is, and I'm using this in a very nice way, but a little bit high maintenance, really wants to make sure that you use the gift for the purposes that he or she is very passionate about, consider a donor agreement. Put it out there, create a template, and use that as a way to make sure this individual makes an informed decision, right? Next slide, please. I don't want to be sensitive to time because as I always do, I talk too much. All right, so I'm going to gloss this over because it'll probably put you to sleep. But let me put it to you this way: when UPMIFA came out, it was really controversial, right? Because it included this language, which was interpreted by some people to basically potentially open the floodgates, or at least create a point of access to an endowment. So there's this language in there that says an institution may appropriate for expenditure or accumulate so much of an endowment fund as the institution determines is prudent. What does that mean? Does that mean we can dip into the historic dollar value? So if I gave $100 grand to the TANGO Foundation, and TANGO looks at that and says, does that mean we can dip into that endowment? We can take 50,000 out because we have so many awesome candidates this year? I would argue it doesn't. Or if it does, it's subject to some very narrow fiduciary conditions and such set forth in the statute. So again, I can tell you that what the Attorney General thinks about this. They think no, this does not entitle you. And if you're a real nerd, I'll send you the letters that went back and forth between FASB, the Accounting Standards Board, and the Uniform Law Commission. Picture two accounting and legal nerd groups just doing this. Like, it's pretty cool, actually. But that it was controversial as far as these things go, at least. Next slide, please. Oh, and I would just add that I think the accounting standards that Amber talked about, I think that those things signal a return to the old school interpretation that the Accounting Standards Board is asking us to really look at the underlying restriction, right? I think that that's key. This is the statute that says, well, here are the factors that the board or the committee should be looking at when they think about tapping into that endowment, right? For example, the general economic conditions. Well, that sounds promising, right? But there's other stuff in there too, other resources, the possible effect of inflation and deflation. These are the factors to think about. And what I always tell clients, and you can go to the next slide, Amber, is that as hard as it is to do this, when a donor impresses a perpetual use restriction on the income of an endowment, really what that donor is telling to you is that I feel so strongly about this gift that I want it to survive even this organization. So in other words, if you close your doors one day, I want this gift to go to another organization so it can continue to help people. And I know that sounds metaphysical, and I suppose it is, but that really is what that donor is telling you. This is really interesting. When we talk about appropriation, UPMIFA puts in some factors that, in my mind, limit the discretion that you have under those more general factors, right? But it's sort of a give and take. It says, the gift instrument, many of which predate UPMIFA, had to have certain language in it to state this limitation. But one interesting thing about Connecticut is UPMIFA, which was a uniform law, it allowed other states to opt into a 7% cap, right? Basically said, irrespective of these factors, you're not allowed to appropriate greater than 7% of the average fair market value of the endowment over the last 3 years, right? So in other words, like, it's presumptively imprudent for you to do that. Connecticut didn't do that. However, I think it's still fair game to look at that and say, geez, if we're looking at tapping into, 10%, 20% of the endowment, this is another thing to me to sort of wake you up and say, this is a serious decision, right? If the Uniform Law Commission, which created this, had this option here, yeah, Connecticut didn't enact it, and that was controversial too between the accounting and legal nerds, but to me, it still matters. It shows to me that there's this, even the Uniform Law Commission said, yeah, we could be on aggressive ground here. So next slide, if you don't mind. How to modify donor restrictions. So you're not perpetuity is a long time, but you're not stuck, right? The donor is still alive. You can go to the donor and say, hey, I know you wanted us to use this, but it's unmanageable. We can't do it. It's impractical. Would you consider modifying the restriction or lifting it? They can modify or they can lift it. They can't take it back, but they can work with you, right? What if the donor is no longer available? Well, you've got a way to go to the Attorney General and possibly the court. And I throw all these terms together because, in my opinion, they sort of just get blended together. And I know some of you, we've discussed this, but it's a construction action, a cypre, an equitable deviation, approximation. It's basically, this is case law, and UPMIFA reflects this, saying we know perpetuity is a long time. If it becomes impracticable to use this gift for what the donor originally intended, there is a process. And I don't want you to think it's some kind of a Supreme Court argument or anything like that. It's not necessarily, it's not informal, but it's also not extremely formal either. So it is a relatively efficient way to navigate that. And many times I'll work with clients, I'll speak to the assistant attorney generals that we work with regularly and say, do we have to do an action on this? How do you feel? They used to do opinion letters saying, yeah, no objection. They don't really do that anymore. But you can work with them and they can give you a little bit of a feel for whether or not this needs to go through a court process. This is a bit beyond this seminar, but there is a variance power. So if you're a community foundation or like a charitable sponsor, like a Jewish federation, for example, you may have another mechanism to modify or otherwise navigate a restriction. So that's something to be mindful of. And there is a termination of small trust statute. So if it's a small gift, there is a way that you could petition the court and say, hey, this just isn't enough money. We can't adhere to this restriction anymore. It doesn't generate enough income to make it worth our while. We want to terminate the trust. And by terminating the trust, you're now unrestricting everything, okay? So the endowment is now unrestricted. So that's something to be mindful of as well.
And is that attributed to also if they just received a small donation from an individual? So I have a client actually in mind that received $6,000 gift many, many years ago to create this endowment, that it was unsolicited, and now it is still just sitting there. They don't even actually have investments because they only have this $6,000 balance. So it's
It might be eligible, Amber. Yeah. You got to look at whether or not it's a quote unquote small trust under that statute. I'll send you it and we can chat offline. But yeah, it might be eligible. It may not be, but it might be. Yep.
Okay.
Yep.
I don't see any other questions at this point.
We put him to sleep by now. So. All right.
So this is an example, exactly what Ed was speaking to earlier, right? So here's a letter that went out to donors. Thank you for your volunteer efforts, your generous gifts over the past years. Due to the current pandemic conditions, there have been unrelated extra costs that were not budgeted for. Please consider contributing to these supports to support these additional unexpected costs. So you may be pigeoning yourself into a specific use of those funds if the donor responds to this letter. So for some examples, please consider contributing to support our operations, right? So that broadens it where you're not stuck using it just for extra unbudgeted costs, which is a little vague as well, but it just might be limiting you. Please consider contributing to support our future needs. Now that one, right, I've seen that in letters as well. What does that mean? Future needs? Is it, could it be considered your starting endowment and you want it to last for the future, propel you, right? So still it's all in the reader, and we all know that we read things and we hear things and we interpret them differently. So it's always a good suggestion. If you're sending out solicitation and you're unsure, send it to someone else and ask them, what do you think? Send it to me, send it to your accountant, send it to Ed, just making sure that the verbiage that you're using is what you're intending it to be.
And Amber and I have had differences of opinion on occasion, and I see that as an indication that, geez, even though I don't know if we're reasonable people, but I would say reasonable minds could differ. And if reasonable minds can differ, maybe we want to take a look at revising this so we both agree. I think that's a good rule of thumb. So yeah.
Right. So here's another example, and we're going to leave it to you. What do you think? All right. So we know that you supported this nonprofit at large member. To us, this means you have continued commitment to our mission, volunteerism, education, advocacy. Over the last 46 years, this nonprofit has contributed $175 million in volunteer work to support trial maintenance and keep public lands in public hands. The new nonprofit fund is being established to secure solid long-term financial base for the future. All right, so I'm going to ask you, what do you think? Is this, oops. Oh, I keep clicking the wrong button. The last poll, launch poll. All right, so what do you think? If you received a contribution to response of this letter, are the funds restricted? Yes, no, maybe.
This polling thing was a great idea, Amber. It's definitely brought this to another level. It's good. I could never have figured it out. We know that, but
it's actually easier than it's. Some people made it. The webinars I've attended, they make it look very smooth, but I fumble through it a little bit. But maybe it's just getting used to it.
Yeah, better than I could have done.
All right, so most of us had voted. So I will end it and share the results, and look at that.
Yeah.
So 43% say it's restricted, 20% say no, and 33% say maybe.
Yep. Yeah.
And so as Ed and I were preparing this is one that we were like, he's like, nope, I don't think it's restricted. And I said, yep, I think it's restricted. But I also have some of the background from this client. So I know that this fund itself, there are endowment monies in that fund. So if I am a donor who contributed to that fund in advance, I would kind of expect for it to be the same.
Yep. Yep. And if I'm coming in as a new donor, I would look at that, and I wouldn't necessarily realize that I was cutting a check into an endowment fund, right?
Right.
And just saying, this, a lot of clients will say, we'd really like you to send in money to help us survive these challenges and to be viable and to otherwise, be in a position to meet these strategic challenges, all those good things that a nonprofit should be thinking about. But I could see, depending on how you phrase it, a donor could think, oh, this is an endowment. It must be. They're talking about, the future and all this stuff. So it is certainly something to be cautious about, I think, for sure.
Okay. So,
Someone had a good comment. The language of the fund seems too general. That is why I thought it was not restricted. I mean, excellent point. I mean, I don't. Yeah, I would say there's not a slam dunk answer on that. But Amber's right. If you have the history and all that stuff, you've got a different thought. So yeah.
right.
I got a little more time, but I know that I want to be sensitive to everyone. Does anyone have any questions? Or it's not like we're going to disappear after this. So we'll be around, and then and then Amber and I will circle up and figure out how we can send something out that sort of fleshes out that concept we were talking about before of the conditional gift, because I think that's really important. So.
Okay.
Yeah, thanks, Amber and Ed. As Amber mentioned, we'll send each of you a copy of the presentation within the next couple of days. I'll also include their contact information in the email. So once again, our partners are here for you. Aside from their discounted services that they provide to our members, I can honestly say that they truly care about the nonprofit sector. So check out their offerings that they have on our website, and they're, like I said, they're always here to help you out. One thing I forgot to mention is that each month TANGO showcases a members organization in TANGO Trends, which is our monthly news journal. So it's great exposure for your organization. If you'd like to get on the list to have your organization showcased, you can send me an email directly, and I will certainly put you on the wait list. And I think that's pretty much it for today. Ed, Amber, do you have any last any last words for you guys?
No, thank you for listening in, especially those who've joined us for a second time. If you have any questions, please feel free to reach out to us anytime.
Yeah, great. So thanks again for joining us today. Stay safe, and we'll see you the next time around. Take care.
Take care, everyone.